As Washington struggles with a national debt surpassing $35 trillion, it abruptly directed $40 billion to a nation experiencing hyperinflation over 200% and a failing currency. The U.S. government was shut down and Congress authorized no spending, yet the money was dispatched. Who approved it? Not the president or lawmakers. It originated from an obscure Treasury tool known as the Exchange Stabilization Fund. Established under Roosevelt in the 1930s, the ESF remained out of the spotlight for years. Now it has reappeared, discreetly used to stabilize Argentina. But why? A genuine rescue, or a hidden maneuver in the financial rivalry between the US dollar and China's gold-supported yuan? To grasp the situation, we must question, was Argentina saved, or was Wall Street? Is this $40 billion a tactical play, or leverage in the worldwide contest with China? And how has one of the biggest unauthorized transfers in American history remained largely unreported? If you're new here, we analyze international economic changes, market movements, and monetary policy. Subscribe now, and let's examine this closely. It started when the U.S. activated the ESF, a fund from the Great Depression that permits urgent foreign assistance without congressional consent. During a government shutdown, the Treasury dispatched $40 billion to Argentina. The Treasury bought Argentine bonds using pesos, a currency plummeting in value. Inflation is so extreme that 1,000 pesos may not purchase basic food soon. Still, the action was called a shrewd investment. Then Trump promised to double the aid, an additional $40 billion, and hailed Argentina's President Milei as his ally. Suddenly, Argentina appeared tied to American interests. Strangely, Argentina isn't a key U.S. trading partner. The arrangement wasn't discussed in Congress or widely reported. It seemed like a private deal among bankers, not states. Authorities claimed, this isn't a bailout, it's monetary coordination. They referenced Roosevelt's 1934 gold revaluation, which yielded huge returns. Instead of returning those profits to Congress, Roosevelt formed the ESF for future emergencies. It has rarely been used to support Mexico's peso in 1995 during the 2008 crash and again in the COVID market panic. Now, it's bolstering Argentina's faltering economy. So, where does the money originate? Is it from taxpayers? In theory, yes and no. The Treasury doesn't distribute cash, it executes currency swaps, dollars for pesos. Officially, the pesos act as security, but their worth diminishes every day. Half of the $40 billion is from the ESF. The remainder is supported by private speculators, banks, and investment funds. But they aren't acting generously. Their stakes are insured by the Treasury. So if Argentina fails, U.S. taxpayers cover the deficit. Why Argentina? Because Latin America is now an arena for clout. Chinese companies lead in energy, mining, and infrastructure throughout the region. Trump's administration views this not as help, but as a retaliation in a monetary conflict with China. China is the leading creditor to emerging economies via its Belt and Road Initiative, deploying over $1 trillion since 2013. The U.S. is declaring, we have returned, rely on the dollar, not the yuan. Treasury Secretary Scott Bessent, an ex-hedge fund leader, is championing this approach. Since his appointment, he has worked to reaffirm American authority over international finance and limit China's expansion. This isn't accidental. It's a component of a wider scheme to reclaim dollar primacy. Many financial institutions hold Argentine debt and anticipate a recovery. If the peso fails, huge sums are lost. So the rescue also protects their investments. In truth, this isn't assistance for Argentina, it's protection for U.S. speculators. But there's a risk. Argentina has defaulted 9 times since 1950. Trust is minimal. Yet the U.S. continues investing, not to rescue Argentina, but to maintain sway. There's also a domestic angle. Trump states that importing Argentine beef will reduce U.S. costs, but that might hurt American farmers. While trying to steady another economy, he may unsettle his own. This isn't merely monetary policy, it's a geopolitical rivalry over who commands global finance. The U.S. is re-engineering the strong dollar to compete with China's gold-backed yuan and safeguard powerful financial elites. Experts now term this the client financial war, between Washington and Beijing. Seen completely, it's evident. America is commencing a new era of international authority, not via soldiers, but through multi-billion-dollar involvements in countries leaning toward China. What many don't know is that each dollar utilized here finally links back to the American taxpayer, already strained by inflation and higher expenses. So this isn't solely about Argentina, it's about upholding the dollar. The U.S. perceives dangers everywhere, while China grows its presence by providing Yuan-denominated credit to needy countries. America's response: utilize financial interventions as instruments of control. No soldiers, just vast currency exchanges to reaffirm the dollar remains dominant. From Washington's view, if they don't act, China will. It's about preserving power. Argentina is the trial, a demonstration of whether the U.S. can still defend its monetary hegemony. The nation is wealthy in lithium, gas, and agriculture, but overwhelmed by inflation, bad leadership, and constant defaults. The U.S. aims to pull Argentina back into the dollar network and retain Latin America within its orbit. Meanwhile, China has put large investments into the region. The U.S. is resisting. These countries are not yours. And who profits most? Giant financial players like Soros Fund Management and Discovery Capital, both deeply exposed to Argentine debt. Treasury Secretary Besant has connections to them. This isn't just about Argentina. It's about creating a monetary alternative to China's gold pathway of banks and ventures across Asia, Africa, and Latin America. America's statement: we remained a global financial bedrock. If the Argentina experiment works, it could be repeated in Brazil, Colombia, Egypt, and Kenya, nations heavily indebted to China or the IMF. The U.S. won't battle China with arms, it will overpower it with capital. In the end, the objective is plain: affirm the dollar's dominance and keep countries bound to its pull. But the pressing issue stays: how long can the U.S. protect the dollar while saddled with $37 trillion in debt? It's a dangerous wager. Either the dollar remains strong, or the entire monetary order starts to crumble.